Welcome, everybody, to Dorsey's Public Finance Annual Training regarding municipal securities disclosure. I'd like to introduce David Grossklaus, a partner in Dorsey's Public Finance Group. David?
Thank you, Matt. Welcome, everybody. Hope you're all doing well and staying safe. This is Dave Grossklaus, as Matt said, from Dorsey and Whitney. I'm going to be presenting today with my colleagues, James Smith and Jennifer Block. We'll tackle some housekeeping matters. We're going to try to keep the program to about 60 minutes today, as is normal. We'll try to cover a number of topics as best we can. Materials and the attendance form, again, are at events@dorsey.com. And please return your completed attendance forms to attendance@dorsey.com, which you can see there on your screen. We certainly welcome questions. In fact, we think that the more questions we have, the more we'll be able to address topics that are top of mind for everyone. And so to the extent you have questions, please feel free to email Mr. Smith at smith.james@dorsey.com, which again, you can see on your screen. I'd also like to give a special thanks to the City of Grimes. As we work through the program, we're going to be using the City of Grimes, taking a look at their the EMA website and the disclosure that the city has filed as some examples. So thank you to the City of Grimes for letting us take a look at their public information on EMA. Lastly, before we get started here, please take a look and check the chat box, which throughout will be providing additional information with respect to this presentation. So let me start just by a quick overview of the agenda that we're going to try to cover today. We're going to touch on disclosure basics again for everybody, hopefully largely reminders. We'll talk as well about the role of the SEC, or the Securities and Exchange Commission. We'll talk about policies and procedures, tackle some questions and answers as we go forward. Disclosure basics. Let me just walk through again, as normal, some glossary of terms just to orient everybody here just a little bit. For most of you, I hope this would be redundant, but for folks that may be new as elected officials or others new to the industry, doesn't hurt to have this as a reminder. So generally in this presentation, when we refer to an issuer, that's going to be the governmental entity that issues the bonds. An underwriter would be the investment bank or the entity that actually purchases the bonds. Generally, they're going to purchase and immediately turn around and resell the bonds. Your municipal advisors are those folks who you work with on a normal basis, regular basis, to craft for you your budgets and your improvement plans and so on and so forth. And then again, SEC is the Federal Securities and Exchange Commission, who is ultimately the entity that sort of serves as the overall regulatory body. And it's the SEC rules that we're all concerned about making sure we comply with. Some acronyms that you will hear us talk about. The OS is the official statement, a POS is the preliminary official statement. And just to remind you all, it's the POS that is used to go out and actually sell the bonds. Once the bonds are marketed and we have pricing information, it's then an official statement, which is then shows the completion of the pricing. A CDC, sometimes referred to as a CDA, is the continuing disclosure certificate. Sometimes it's a continuing disclosure agreement. They're one and the same. A dissemination agent agreement is then the agreement you might have with a municipal advisor, or a trustee or some other entity, an independent third party that might help you, to the extent you've engaged those folks, to make sure that your information is then filed on Emma as part of your continuing disclosure role. I'm going to add one other concept here, just for everybody to keep in mind. Sort of two forms of disclosure that we're going to talk about in terms of primary disclosure and secondary disclosure. Primary disclosure, when we're referring to that, we're talking about when you're actually issuing the indebtedness. So when you're preparing the official statement and the preliminary official statement, that's in, and the due diligence process, that is in preparation of your primary disclosure when you're actually selling the debt. Secondary disclosure, that's where we're talking about the continuing disclosure agreement compliance and Emma, and that's your updated information that's going to the secondary market. Just to highlight that a little bit, years ago, it would have been quite the norm that investors would have purchased your bonds with the full intent to hold those bonds all the way through maturity. So for sake of argument, let's say the full 20 years of the life of the indebtedness. Nowadays, that's not the case. The muni market is very, very fluid. And so investors may be purchasing your bonds on any given day at primary offering, but they may sell those bonds in 1 year, 2 years, 10 years, and so on and so forth, depending on what their investment needs are at any given time. So much like the corollary for the corporate world would be stock, where folks go in and out of stock purchases or even corporate bond purchases. The same is really true now for the muni market. Let me just touch briefly on roles of counsel. So I've talked about underwriters. So underwriters counsel would be legal counsel that would actually be representing the underwriter. Generally, that's going to occur in a transaction where you have a negotiated structure as opposed to maybe a competitively sold deal. They, along with issuer/disclosure counsel, assist in reviewing and preparing the official statement. Generally, it would be underwriters counsel that might prepare a bond purchase agreement and deliver a 10b5 opinion to the underwriter, similar to disclosure counsel representing the issuer, who would be, in our case, preparing and providing a 10b5 opinion directly to the issuer, city, county, issuer of the bonds. Generally, they also, as underwriters counsel, are going to take a look at compliance on behalf of the underwriter, making sure the underwriter's meeting their duties and regulatory requirements in review of the CDC and compliance by the underwriter with Rule 15C212, which is the Securities and Exchange Rule with regard to continuing disclosure. Let me just talk a minute while we're on the subject of opinions, how the content of at least our opinions is determined. So the first decision point, I guess I would refer to it as, is who's Dorsey representing and what's our engagement letter. So for instance, if we're hired as disclosure counsel, we would always intend then to give a disclosure counsel opinion encompassing 10b5 directed to the issuer. To the extent we would not be hired as disclosure counsel, obviously we wouldn't be giving that opinion, and the only opinion we would presumably then be giving with regard to that transaction would be a bond counsel opinion, which would only go to tax issues and would not speak necessarily or at all rather to any of the disclosure issues related to the transaction. Other professionals involved in the financing. So just because, and this is probably one of the main points, just because an issuer goes out and hires other professionals, that does not mean that the issuer necessarily absolves themselves of liability. Those individuals are hired to aid the issuer in the process. But fundamentally, the securities, the bonds, the notes are securities of the issuer. And so the content of the official statement is the responsibility of the issuer. Again, not to say, certainly it makes sense that the issuer is relying on professionals to help them and assist them in preparation of the OS, but it should not be misconstrued by anybody to think that the hiring of professionals means that somehow that absolves the issuer of liability or responsibility for the content of the official statement. Official statement is a securities document that is the issuer's bonds. Let's talk a minute about the regulatory framework, again, that we're striving, quite frankly, all parties to meet. As we've talked about, the Securities and Exchange Commission creates the regulatory framework. That construct are a couple of rules. For primary offerings, it is the 33 Act and the 34 Act. Most importantly, and probably most concisely, the rule that is fundamentally necessary to meet is what will be referred to as Rule 10b-5. Again, is that is what our opinion would speak to. And at its core, Rule 10b-5 provides that there can be no false or misleading statements or omissions of material fact within the offering document. Breaking that down just a little bit, keywords there are, first of all, materiality. There is a materiality threshold, of course. Materiality means generally through case law and other situations that there's a substantial likelihood a reasonable investor would view a fact as significantly altering the total mix of the information made available. Not to be misconstrued or misunderstood. The importance of 10b-5 as well, and one of the main focuses of due diligence, which we'll talk about here a little bit later, is to make sure not only that there's not a material misleading statement of fact, but also to make sure there's no material omission of a fact that would be viewed as important by investors. The consequences, and not to scare folks, but there can be both civil and criminal penalties. Certainly for governments, there's a significant risk as elected officials of reputational harm. However, again, it should be noted that lately the SEC has begun to impose criminal penalties along with civil penalties directly with respect to individuals in their role with respect to the issuance of municipal indebtedness. As noted here, again, governing body employees, I mentioned officials certainly can also be employees, city managers, city clerks, so on and so forth. Anybody involved in the process for an issuer can be held personally liable. Moving on, then the other rule, and this rule really goes to the secondary disclosure aspect of municipal finance. It's Rule 15C212. Oftentimes misunderstood. because of what's referred to as the Tower Amendment, the SEC does not have direct authority over issuers. So Rule 15C212 at a very technical level is a rule that is directed at underwriters. However, obviously, it impacts issuers because when an issuer enters into a contract, i.e. the continuing disclosure certificate or agreement, that then is how 15C212 applies to issuers. So I wouldn't want folks to not think that C212 doesn't apply to issuers. It certainly does. It's just the SEC devised through 15C212 sort of an indirect methodology to get around the Tower Amendment so that they could apply continuing disclosure rules to the issuers themselves. As part of C212, though, applying to underwriters, the underwriter, in order to actually sell the bonds, has to make sure there's certain information that is disclosed on an ongoing basis, generally referred to as your annual financial information, which would be your audits, operating data, the information that you would usually find set forth in what we refer to as Appendix A. And then secondarily, as part of continuing disclosure, material event notices, of which there are 16, and we will talk a little bit about those here in a minute. I'll just note here, moving on, for non-compliance, it's a 5-year look back that needs to be reviewed for the issuers with regard to compliance with their ongoing disclosure requirements. And then not to be lost within any of this, there's always the overlying or overarching concept that all the documents are always subject to the anti-fraud provisions. 15C212 material events, or the listed events that are required to be a part of all continuing disclosure. You see them there. Items 15 and 16, we sometimes refer to them as the newer events. In fact, now not so new. You can see there these financial obligation events came into being in the spring of 2019. So now we're already 4 years into the new financial obligations. These the 15 and 16 are the two events we get the most questions about. They're the most reviewed events, and for a number of reasons, including materiality, what is a financial obligation, so on and so forth. So a lot of examples, a lot of questions for individual issuers as to what their potential or what their general materiality threshold might be. So I would just urge everybody, those types of events, if they occur, if you as an issuer entering into any kind of indebtedness or an obligation where you're going to be making payments for a significant period of time, those are the types of contracts or agreements, leases, any of those types of documents that we'd certainly want to talk to you about, whether we think those rise to the level of financial obligations for which we need to file a material event notice on EMMA. Breaking those down on the next page, you can see there the two things that we're really looking at, again, materiality and what is defined as a financial obligation. Again, we put those in front of you just as things to think about. I would highly urge any of you that, to the extent you have an instrument that looks like it might be debt or that looks like it might be material, please don't hesitate to give us a call. We can walk through it and make sure that we're all in agreement as to whether it needs to be listed as a material event for your ongoing disclosure. I'm going to jump just a little bit further. I'll let you folks all read the interpretation of events 15 and 16. Moving over to then disclosure considerations. Any number of things to consider when we're in a primary offering. The first thing that we always need to take a look at is what is the type of security that's being issued? Is it a general obligation indebtedness? Is it a utility revenue indebtedness, which obviously there are different securities, sources of payment and so on that we would look to in terms of describing what is a potential risk in the offering document. Sales tax issuances, tax increment, road use tax, all of those different types of issuances, whether it's realized or not, clearly have different security payments, different risks that we would focus on as we would prepare the OS. No matter what type of debt you're going to issue, again, 10b5 is the guidepost that we're always going to be striving to make sure we're meeting. That does apply with respect to materiality to your OS, and always applies as well to those material events that are financial obligations. Let's talk foundationally for just a minute about the due diligence process and why this is, sort of a hassle to some extent, but it is the due diligence process that really confirms for all the parties that we are meeting that 10b5 standard of not misstating any material fact. Most importantly, I think the due diligence process is not given enough credit for making sure we don't omit to state something. So for those of you who have been through a primary offering with us, you would have received a due diligence questionnaire, a lot of questions. Some of the questions are similar, but asked in a different way. Again, the whole purpose here is really just to have the issuer be thinking about all the different variations to make sure that we're not running into something that we really do think is a risk, and maybe it just wasn't thought about in the context of the issuance of indebtedness, maybe something new. There are also a number of questions in the due diligence process now as well that are guided by SEC pronouncements. So as an example, one of those pronouncements a few years ago was making sure to be mentioning where issuers stand with regard to pension obligations. More recently, there are pronouncements, and there's a lot of discussion and question and due diligence around what is shorthand referred to as ESG, or environmental, social, and governmental impacts related to your bond issuance. A couple of those issues we don't see as much in Iowa, but nonetheless, the SEC has formally made pronouncements that those are issues that they're very keen to make sure people are discussing. More importantly, those are the types of issues you're going to also get questions when you're talking to rating agencies, when you're putting together your offering documents or trying to sell bonds. Generally, we have a due diligence call to then go through those questions, make sure everybody's comfortable again that we're meeting the issuer's 10b5 requirements. I'm going to skip over. You can read next compliance considerations of the different parties. Due to timeliness, I'm going to try to move on here, so I might give my colleagues their just due in terms of time. Mr. Smith, I'll turn it over to you.
All right, thanks, Dave. Good morning, everyone. So this part is only going to be a few minutes, but that doesn't lessen the importance of this particular topic and the role of the SEC, as Dave touched on earlier. The main reason that we go through all these, the process and the diligence process, is to get comfort that we're satisfying the applicable rules of the SEC, mainly anti-fraud and disclosure rules. So clearly, if you've been on this webinar for a while now, in the last few years, the SEC has been paying much more attention to the municipal market, and that's not going to change. In fact, it's continuing and expanding as well. One of the aspects away from primary disclosure, secondary disclosure, one of the other aspects we wanted to talk about a little bit was a 2020 bulletin. So it's now been a couple of years since this has been out, but it's making it clear that in the view of the SEC, the anti-fraud rules, they don't just apply to your official statements, your primary documents. They don't just apply to the ongoing secondary continuing disclosure, but it really is a pretty broad concept that if an issuer is making some sort of a statement that could or is reasonably expected to reach investors, that could be subject to the same anti-fraud rules. And so some examples of what that could mean: information on your governmental website. Even if you have historical information, current information, that is subject to the anti-fraud rules, because when investors are considering buying bonds in the secondary market down the road, they might reasonably look to your website, see what's going on with a particular issuer. Be careful on hyperlinks, whether they're accurate. Summaries of financial performance. The overarching theme is if the information is accurate, then we're okay. Then there's nothing to worry about. But it's worth confirming that the information is indeed accurate. Another type of category that would be covered: reports filed with other state or governmental bodies. So in the context of cities, for example, think of the AFR that's filed with the state. Because that's filed, it's a public document. Investors could reasonably, dig around and find that. So again, you want to meet the threshold of it not being material and misleading or omitting to state some information. Finally, statements by municipal officials. Obviously challenging to cover this ahead of time, but just generally, if folks know that depending on the context and what they're talking about, that those statements could reach investors. And so it's just something to be cognizant of as well. The next 4 slides, I'll run through these relatively quickly. They're just 4 fairly recent examples of SEC enforcement action, and really just intended to give a broad picture of the types of things that the SEC is looking at. And as you'll see, a lot of it is financial statement related and things that are clearly, when you look back at it, several people should have been maybe scratching their head and asking some additional questions when you get into either very stale information or just misleading financial statements or not telling the full picture. The first one you can see is a very large school district in the San Diego area. And the bottom line here was the SEC went in and said, we think you're using old information in connection with the bond offering. And as a result of that, the school district agreed to do several things, and the CFO also was invited to and paid a penalty. As you'll see, the CFO also, because they're the gatekeeper of a lot of the information, is a frequent party looked at when these orders come through. The next one is another school district, and really this is just intended to show that you don't have to be a massive school district in San Diego. This one maybe still large, but a little smaller, and it's a similar situation. They looked at the district and the CFO and the auditor and said, look, your audit was wrong, and you used that audit in the offering of bonds, and now you've got a problem. Let's go to the next slide. So here's a small town in Louisiana. Again, similar situation. They used some misleading financial information and misleading projections when they were selling bonds several years ago. The SEC comes in and looks at this, you know, down the road and after the fact, and it's you know, there's probably a pretty clear path of information that was not accurate or told the full picture. And lo and behold, the SEC files a 10b5 complaint against the town and several other parties. And then the last one is a city school district in New York. And again, the common theme, the SEC says, hey, you misled investors because your financial statements were outdated and did not really reflect the current financial difficulties of the district. And you can dig into each of these and see some pretty specific facts that it's, you know, relatively hard to argue that maybe the SEC is overreaching. It's information that probably should have been fixed. And so the common theme is your audit obviously needs to be accurate. We'll talk maybe a little bit later about timing of audits if we have a chance, because we know a lot of that is outside of the issuer's control. But it is something that we have to tackle if you are issuing bonds and your audit is maybe not ready or stale. Then there are some steps we can take to at least confirm the information and make sure that we are not violating the 10b5 standard. All right, I think with that, we'll turn it over to Jennifer on some policy and procedures discussion, and then open it up towards the end if there are questions. Thanks.
If I could just add one quick thing, you know, the cases, hopefully that James outlined, take a look at them. Yes, there's some bad behavior, but I think the one takeaway not to be lost here is that the SEC is very focused on, or as focused on, small issuers as they are large issuers. So, you know, we generally operate, I think, where most of the issuers of Iowa will be considered small from a national basis. But you can see from the cases, population of 2,600 in Sterlington, Louisiana. So please don't ever think that just because you're only issuing $2 million, $3 million, or that you're a small community, that the SEC is not going to be harsh, perhaps, in their view of what we're doing in this state with regard to our disclosure. You are issuing securities. It's a massive securities market, and the SEC is going to always really make sure they're protecting investors. So.
Thank you, and good morning. We will talk about policies and procedures next, and wanted to run through some things that we would normally cover in your compliance policies and procedures. And in those conversations, we usually talk about 3 different buckets. The first 3 items that are listed on the slide here, when you've got your new bond offering and your then once the bonds are sold and you've got that continuing disclosure obligation in the secondary market. And then we'll talk about the systematic training. And then this year we incorporated an additional component and wanted to walk through Emma, because another piece that we spend time with our clients is the importance of the issuer themselves. As Dave said earlier, the offering documents and the disclosure obligations really are that of the issuer, even though you've got some, in many cases, an excellent professional that you've hired to be part of your process. It's good for the issuer to take a look at Emma, and in some cases, I think folks have been a little bit intimidated by it. So we wanted to show a little walkthrough on that. So yeah, thanks again to Grimes for letting us pick on you a little bit. So first, we'll talk a little bit about that compliance program and the policy. And so that is broken down into 3 main pieces when those bonds are first being taken to market. And then after those bonds are sold in number 2, there's that ongoing compliance obligation. And then 3 is our systematic training. And so we offer this training every year and find that it's helpful, or hope that it's helpful for clients as they undertake that annual training. And then for some whose governing bodies are not able to tune in, I know several folks have told me that they pull slides from this or give some highlights to their, whether it's their city council, board of supervisors, or hospital boards, things like that, that they can use this information to help everyone in the process be comfortable. As we're looking at that first bond offering, these are some steps that we outline and hope are helpful. It's just kind of like undertaking any other project. You need to plan for it and make sure you've got a timeline built so that everyone can be ready at the right time. There's the involvement of a very important person in the issuer's group, and that would be who we would identify as the disclosure officer. And so that's the person who's really kind of a key point person for coordinating pieces. They're working with their financial professionals, they're working with legal counsel, and they're just a great conduit for all of the information that needs to be exchanged and shared. And we walk lockstep with them in terms of preparing the official statement, getting that out for review, and getting people sign off, which I'll just drop a quick footnote here. For some who are newer to the bond issuance scene, we'll get a lot of questions about when we send out documents for review and we ask for sign off. Really, we just need an email back that says, hey, we're good, or maybe I've got some comments or questions. And so just file that in the back of your minds for the next time that we're partnering on a bond offering. Next, we would talk about disclosing any of those previous failures to comply with your continuing disclosure obligations. And as Dave talked about, there's that 5-year look back. And so we'll kind of weave that through as we talk about some of these other pieces. And then finally, another part of that process is making sure that all the parties involved have enough time to review those documents and that they have an opportunity to ask questions. And so when a preliminary official statement is going to be used to market bonds, that document or a pretty near final version of it that describes all the material components of the offering are provided to the governing body, whether it's your city council, your hospital board, your board of supervisors, that they have an opportunity to review it, and then they approve it and can ask that disclosure person questions, or perhaps even the financial professional who's been involved in helping the issuer get that bond offering to market. They sometimes have attended those meetings and can talk numbers and crunch that with them. So as we talk about how this disclosure plays in with the regulatory requirements, with 15C212, the issuer does have to file certain things on this EMA website. And as I said, we'll take a peek at that here in just a few moments. Those pieces need to be filed on the website, and very, very important part of that is that the documents must be in a searchable format. So PDFs that have been scanned, those don't work. They need to be converted or saved in a way that can be searchable. And another thing, and I'll mention this later too when we talk about some of the continuing disclosure, is the documents that have to be attached. Something to keep in mind is to redact signatures. So I'll kind of explain what I mean here in a minute, but we'll walk through EMA. And again, we're not trying to be too scary, but we also want to make sure that everybody walks away with a very clear understanding that the issuer is responsible. They can hire dissemination agents. Like I said, there's great professionals involved in the process quite often, but we want to make sure that issuers are taking that ownership and have a good understanding that if those filings that the issuer has promised to make, if they're not made, or they're not made on time, or they're incomplete, they basically have to confess that sin in the next time that they take bonds to market. So it could maybe have an a negative effect on the ability to get those bonds sold the next time around. Highlights of what we've just covered, that disclosure officer, it's a big role, and wanting to make sure that the folks in those positions really understand things. And if they have questions, we are always happy to help navigate. And so don't be strangers. When we do a bond offering and we talk about what's required in that continuing disclosure certificate, as Dave said, there's going to be 16 items that are always going to be included. Those are material events. You've got 10 business days to get those filed, but no one can help an issuer get those filed unless they know about it. And so it's just really critical for issuers to keep their dissemination agents involved and in the know, and talking with counsel just to make sure that everybody's on the same page if maybe some kind of a new financing arrangement would trigger one of those event notices under 15 and 16. Part of the policy that we often prepare for clients, it includes kind of some sample tables that can be used to track those obligations. And so you'll see in that first snip of a table where this should look familiar to a lot of you, where we've listed the name of the bond issue, when it was issued, and then that final maturity date. That's the one that I think folks get to celebrate, because their obligation to make continuing disclosure filings is over at that point, and your bonds are paid for. So we like to make sure everybody's clear with those deadlines. And then also the final column is, when is that filing due? And another thing, I guess, in terms of filing deadlines is if your filing deadlines and your continuing disclosure obligations have shifted around, and they sometimes have different deadlines, you just need to be really mindful of that things with an earlier deadline, those deadlines need to be met. So we would encourage that disclosure officer also to make sure they've got all the copies of the agreements, their final offering documents, and those continuing disclosure certificates. Keep a good file and records, such that if there are any questions later, that you've got evidence to support all of the actions that the issuer has taken. When it comes time for training, I think it's a good idea for disclosure officers to make note that whether you've attended this training or you watch it when the recording is available, it's a good idea just to make note of that. Or if you've got on your city council or board of supervisors agenda a listing of some training of your governing body, that's nice to have too. And then you'll also see that you can, I guess that second table, then that also covers kind of a breakdown. That's got all the details. But for any folks who've got a policy prepared by Dorsey, you will see that where it's a breakdown of all of the pieces that are required. This slide is really kind of breaking down those different suggested timelines. So review that, and I suggest people calendar it. If you've got a dissemination agent, they're usually having a good schedule for making sure those filings are made on time. But I like the belt and suspenders approach, where the issuer also has something calendared and can keep track and make sure that they're ready to go. And again, this list of 16, familiarize yourself, make sure you know what's on here, and those items have to be filed within 10 business days of their occurrence. So if you've got rated bonds, one of the things that can sometimes catch people by surprise, because so many of these items on this list of 16 would indicate that there's some trouble financially for the issuer, even when a rating changes for the better, that also triggers a filing. So make sure you're keeping an eye on anything you get from S&P or Moody's or anything like that. Dave talked about, and we'll probably talk about it again if we've got some time, those audits. It's unfortunate it's out of your control in terms of when you get those received, but just make sure that if you don't have it ready, you still have to take some action so that you don't get a demerit for filing it late. You can file an AFR for cities just to give some unaudited information, and that can kind of help keep you in a good position. there. And so I guess, yeah, that's what we want to say there. And then in terms of the training, you know, keep following up with that you've got those on the schedule and you're keeping track. And then we'll get moving here to Emma. So we've got some time to walk through this. So we always talk about like check Emma, and sometimes you can even sense over the phone a little hesitation and some nervousness that it can be kind of a scary thing. But my intent here is to demystify this for you a little bit. If you go to the emma.msrb.org, this is basically what you're going to see when you get there. And there are multiple ways once you get to this position that you can dig in and look at your particular filings. You can go to the state map and you can click on Iowa, and then you'll have some other search choices. If you know your QSIP you're checking, you can type that up in that search bar up at the upper right side of the screen, or you can tap on advanced search. I tapped on advanced search just so that you guys can see that it's really not that scary. There is a place where you can plug in state and you can put in all kinds of details as you see here. I did it very generically and I just said state and Grimes. And then this is just a portion of what you'll see. So it's got a full list of all of the different bond offerings and some of the information that would be available. And so the tab we're looking at is just the listing of all of the different bond issues. But as you can see across the top, you can look at the trade activity, pre-sale documents, official statements, refunded issues, financial disclosures, and the event-based disclosures. Here, if we look at the financial disclosures, this is kind of a repository where all of those annual kind of known events. So when your continuing disclosure certificate has kind of the two buckets, the known things that you need to file for, like your audit and different pieces from that Appendix A, then you've got those kinds of things would fall into this category. This is where you could find a complete listing of everything that Grimes has filed in effort to satisfy their continuing disclosure obligations. And then when I clicked on the event-based disclosures here, you can see where the city of Grimes has made filings that relate to one of those 16 items. So in this case, you can see they've had a number of different financial obligations, they've called bonds, and those are all listed. And where you see the little PDF with the green arrow, you can click right on that button and see the document that was in fact provided and uploaded to Emma. When you go to that listing that had all of the different bonds that were offered by Grimes that were listed on Emma, I went and I clicked on the 2020A series. And so if you click on that, you're going to see a presentation like this. And so it's got various pieces of information. And the tab that we're looking at here is the final scale, but you can click on each of these other ones. So for example, if if you click to the tab that's immediately to the right of final scale, you would see the official statement. So you'd have an opportunity to click a button there and pull up what was the final offering document for the city of Grimes, and that's the one that would include all the pricing information. But since we're talking about continuing disclosure, I clicked on the continuing disclosure section. And so here's just a couple slices of what is on that landing page. So you can see on the piece that's on the left side of the screen, financial information and documents. And so it'll list what was the most recently filed item up at the top left. And then there's a breakdown depending on the category of information. Annual audits are listed there, and then that operating data again being the kind of information that was listed in Appendix A. And then the second part of the screen over to the right, that lists the event notices. And so here again, those are that filings that would represent pieces from those 1 through 16 items. And so the city incurred financial obligations that were relevant to the timing of when these bonds were issued. And there you can see the evidence of those filings being made onto Emma. And then it comes all full circle. So, why do we do all of these things? It's so that, we've got that the city's promised to make these filings, they make them, and now let's say, in 2022, when Grimes issued some additional bonds, set forth in their official statement, and then even in the preliminary official statement that was used to market the bonds, there would be this section that's at the bottom of this slide about continuing disclosure, and it gives just kind of an outline of, we expect to enter into another continuing disclosure obligation as a result of these bonds. And oh, by the way, here's how we did for the last 5 years with all of the other continuing disclosure obligations that we've undertaken. And so Grimes is in a great position that they can say, over the last 5 years, they haven't failed to comply with their undertakings. And so you just kind of watch how the whole process flows through. You've got, the bond offering, in that offering, you're making promises to make certain filings on an ongoing basis. And then the next time around that you go and do a bond offering, you take a 5-year report card basically, and then talk about how you've done.
If I could just add here, so if you go back to this slide, the prior slide, please. So what is the reason for being so emphatic to make sure that statement is correct? Well, years ago, there was an SEC situation called MCDC, where the SEC was very concerned about continuing disclosure compliance. At that particular time, the SEC focused on the underwriters, and basically every underwriter in the country was fined a significant amount of money because, again, 15C212 is a compliance rule for the underwriters. And as I said earlier, though, the way that it attaches, so to speak, to issuers is a result of your continuing disclosure agreement. But my point is that the SEC has said for issuers, these statements are material in and of themselves. And so while they can seem rather innocuous, while some of these, I'll call them foot faults, if you don't comply, or if you might be late in filing a notice on Emma that's a material event or what have you, the SEC has said when you're doing a primary offering and when you're setting forth what your compliance has been over the prior 5 years with your continuing disclosure, that in and of itself is a material statement. So that is the reason for all of this background sort of due diligence with respect to continuing disclosure. Sorry, Jennifer.
Oh, you're fine. Yeah, and then part of the process when Dorsey serves as disclosure counsel is, digging in very deeply to all of the outstanding bonds and checking what do all those continuing disclosure obligations say, and then paging through filing by filing on Emma just to make sure that we can feel comfortable about putting that statement into the offering document and being comfortable with its accuracy. And I started to say earlier, like in terms of filing financial obligations, those, like every other Emma filing, have to be in a PDF that's searchable. And then quite often with these financial obligations, in an effort to not leave out a material item, you can describe the gist of what is in that financial obligation document, or quite often issuers will attach a document. It just kind of depends on the circumstances, but if an actual like development agreement or something like that is filed, you just got to make sure that even if it's a scanned one with a signatures, you redact your signatures, and then we also want to make sure that we can still search it. So I just kind of want to close the loop on that piece. But you can read our little conclusion, but I think I'll see if James has received any questions, or if we've got some other pieces that folks are interested in hearing about.
Yes, thanks. So just a couple of questions. So the first one that came in, Dave, will ask you, can you have the same attorney as for your bond counsel and disclosure counsel, and maybe same attorney / same firm, or walk through what those options can be?
Sure, good question. And disclosure counsel, I'd say, is a somewhat new concept over the last 5 to 8 years. Again, somewhat emanated from the continuing disclosure MCDC issues that the SEC raised a number of years ago. So the quick and easy answer is yes. In fact, when you serve as bond counsel, you're representing the issuer. When you serve as disclosure counsel is also representing the issuer. So certainly that can be the same firm. Fiduciary responsibility for both roles is to the issuer. Bond counsel, the difference, I guess I would say, is for bond counsel, you're really focused on giving an opinion ultimately that the debt issuance is federally tax exempt. And then disclosure counsel, the focus is, again, a 10b5 opinion to the issuer that they have met their 10b5 responsibilities in the issuance of their bonds.
All right. One additional question that I'll cover very briefly. It's about impact of GASB 87, which is lease accounting and how that might impact continuing disclosure. Certainly no expert at all in GASB 87, but as far as how that drives the financial disclosure, whatever the end result is when working with the auditors and the accountants, as long as that's then covered in your audit, which is filed on EMMA, I don't think there's necessarily a separate continuing disclosure obligation. It gets subsumed with the disclosure in an annual audit. With that, Dave, do you want to speak a little bit also on ESG and/or Iowa legislation or any other topics? Looks like we have about 2 minutes before we need to wrap up.
Yeah, let me quickly touch on a couple issues. I'm first going to hit audits because that seems to be a big topic, and certainly it's a focus of the SEC. So just going back, one of the things the SEC really dislikes about the municipal sector as opposed to the corporate sector is the fact that even under the 15C212 rules, the municipal world really doesn't provide updated financial information anywhere nearly as robust as or timely as the corporate world. So most corporations are providing quarterly financials. The SEC has sort of attacked the muni world for many years, desiring to have all entities provide quarterly updates. Clearly would be unaudited. What we've seen lately in Iowa, I think partly stemming from COVID, partly from the fact that many number of issuers in the state are having their audits done by the state auditor's office, are just simply not even receiving annual audits on a timely basis. So a couple of issues there. We've started to look a little bit at AFRs as some interim financial information we can point to, although if you take a look at audits and 15C212 compliance and so on and so forth, it really doesn't fit. An AFR really doesn't fit very well. An AFR, I'm referring to an annual financial report. Most importantly, though, the point with audits and continuing disclosure is you have 10 business days under C212 to file your audits once received. A big problem we've run into lately is when, in fact, is an audit received? Is it the date that the auditors put on the audit? Is it when perhaps a city clerk receives that audit? Again, what's the time frame? When are we saying the time commences to get that audit posted? And so we're urging everybody. We think it makes a lot of sense to have your governing body formally approve the audit once it's received. And then that formal governing body approval would be the point at which we would say, okay, now the time commences to get your audit filed timely or allow us to determine whether it's late. So the process would be receive the audit, but then actually have that audit approved formally at your next city council meeting, your next board of supervisors meeting, whenever your governing body meets next, and actually have that governing body adopt a resolution or make a motion to formally receive the audit. And then that's the date we can use to determine timeliness of filing. And hopefully that process will also cause all of the issuers to think, oh, okay, now that we formally approved it, now it is time to go get that audit filed. So we're over time. I think we'll conclude there. Again, thank you all for attending, and be safe, and let us know if you have any additional questions.